Hi friends, welcome to EIKV and this is Vishnu. In this illustration, Electronics Limited is manufacturing a new pocket video game. So the capital expenditure or capital investment of the project is 600 lakhs and the firm needs a working capital of 150 lakhs. The total capacity of the plant is 12 lakhs units per annum. The working life of the project is 6 years and then they have given the working capacity of each year which is given in percentage as first, second and third year. The capacity of production will be 33 and 3 percentage, 6.6 percentage and 90 percentage. From 4 to 6 years there is 100 percentage. The selling price of the pocket video game is 200 unit. The contribution is 40 percentage. Annual fixed cost excluding depreciation is 480 lakhs. Okay, before that in the first year the fixed cost will be 240 lakhs and on the second year it will be 360 lakhs and from third year to last year the fixed cost will be 480 lakhs. Okay, depreciation is 33 and 3 percentage which is allowed in income tax and the tax rate is 50 percentage. Additional investment is required on the third year at the end of the third year of rupees 100 lakhs and the total salvage value of fixed asset will be 10 percentage and the current asset which is working capital is 100 percentage and calculation can be round off to lakhs. Cost of capital is 15 percentage. So guys, in this question they have asked the feasibility study or whether to accept this project or not. So at first I have computed the net present value of cash outflow which is we have spent or the cash which we have invested for doing the business or for getting the return. Therefore, as we have given in the question, the cost of capital is 600 lakhs, working capital is 150 lakhs which is also given in the question, and the cost of additional capital at the end of the third year will be 66 lakhs, which means the question which is given that there is an additional investment is required which is 100 lakhs at the end of the third year. So that 100 lakhs multiplied by the PV factor of the third year which is 66. So to compute the PV factor I have made a table which contains year and PV factor and the PV factor is the cost of capital or the cost of capital given in the question is 15 percentage. So how we will prepare the cost of capital or how we will prepare the fee factor is nothing but we need to take 1 divided by 1.15 which is 1 plus 1 plus 15 percentage. So 1 divided by 1.15 gives 86.95. So that is the pay factor for the first year, and for the second year we need to divide the pay factor of the first year divided by 1.15. So we'll get second year and so on. You need to compute till 6 years. Okay, after that, after computing the PV factor, we will get a cash inflow of rupees 816 lakhs. Okay, so we have taken the PV factor of the third year which is 6.657 which is round as 0.66. After computing the cash outflow we have gone for the cash inflow. So for computation of cash inflow I have made a table which contains year, capacity, percentage of production, production units, sales price, total sales, contribution, fixed cost, depreciation, PBT, tax, PAT, depreciation and cash inflow, then P factor, finally cash inflow, present value of the cash inflow. Then the year I have inserted 6 years and the total capacity of the project per annum is 12 lakhs which is given in the question, and the percentage of production will be 33, 60 and 90 which is given in the question as a table. And when we multiply total capacity with the percentage of production, we will get total production unit. Sales price, it is given the question as 200 per unit for each product. So when we multiply sales price with total production unit, we will get a total sales in rupees, which is 800 lakhs, 1600 lakhs, 2160 lakhs, 2400 lakhs each for 4 to 6 years. Okay, after that it is given in the question that the contribution percentage is 40%. So when we multiply 40% with the total sales, we will get the total contribution as 320 for year 1, 640 for year 2, 864 for year 3, etc. After that we need to subtract fixed cost and depreciation from the contribution. Fixed cost as given in the question as first 2 years is 240 and 360 respectively, and from the third year it is 480. Okay, then depreciation. For depreciation I have made another table which contains year, book value and depreciation as columns, and there is 6 years, and the at the time of purchase we have 600 lakhs as total capital investment, and the depreciation rate is 33.33%. When we multiply 33.33% with 6, the total capital value of 600, we will get 199. And like as you all know that written down value, when 600 minus 199, we will get 400 lakhs, and so on. We need to compute the depreciation as 33 and 33%. After that, after 6 years, the book value will be 52.6907. Okay, after computing the depreciation, we need to subtract the contribution. We need to subtract fixed cost and depreciation from the contribution. We will get PBT, and from the PBT we need to deduct tax as 50%. 50% tax shall be deducted. We will get PAT. After that we need to add the depreciation. Depreciation is not a cash expenses. It is a non-cash expenses. Therefore we need to add it back. We will get cash inflow. And when we multiply PV factor with cash inflow, we will get the present value of cash inflow. So the PV factor is nothing but we have already computed as 15%. We need to just take that and just paste it over here, and we will multiply it and total it. When we get the total as 826.233 lakhs. Okay, after that we need to compute the terminal value of the cash inflow for the last year. For that it is given in the question that the salvage value of the capital asset will be 10% of the total capital investment value, which is 600 multiplied by the 10%, which is 10 by 100, will get 60. Okay, less tax on profit on sale of scrap or profit on sale of capital asset, which will be 60 minus 53. Okay, 60 is the salvage value of the asset, and 53 is the written down value of the asset. Okay, here the written down value is 52.6907, and we will round it as 53. So we will get a profit of 7 lakhs, and 50% of the profit is taken as tax. Therefore tax is an expense towards the company. Therefore we need to deduct such tax amount from such profit. Okay, so 7 lakhs into 50%, we will get 3.5 lakhs, and we need to deduct it. After that we will get the salvage value of current asset, which is the salvage value of current working capital, which is 150 lakhs in the beginning of the year plus 100 lakhs at the end of the third year, which gives you 250 lakhs. And when we take the sum of all three, we will get an amount of 306.5 lakhs. Okay. After that we will get into the final decision, calculation of net present value. For that we need to deduct cash outflow from cash inflow. So cash inflow of the project will be the cash inflow of the 6 years, which is given in the table, or the second working as 826.23 lakhs. Okay, we have taken 826.23 lakhs. After that we need to add the terminal cash inflow, which is 132.2838. is 132.2838. We have added such cash inflow, which is the terminal cash inflow. After that, we need to deduct total cash inflow, which we have computed in the first table as 816 lakhs, and we take the sum, or when we multiply cash outflow from the total inflow of the project, we will get a positive amount of 142 lakhs, 142.5 lakhs. So from this illustration we can get the conclusion that the project is pretty much viable, or the NPV is positive, therefore the project is acceptable towards the company. So guys, thanks for watching this video. If you find this video helpful, please subscribe to my channel.